Good afternoon and welcome to the Conduit Holdings Limited Q3 trading update. Throughout the recorded meeting, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time via the Q&A tab that's situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Neil Eckert. Good afternoon to you, sir.
Hi there and good afternoon. I'd like to spend just 2 or 3 minutes introducing the company, why we started it. Then I'll hand over to the team to go through the slides. I've known Trevor since the early 80s. I was a reinsurance broker at a company called Benfields, which is now part of Aon. Trevor, back in the day, was at a company called Folksam, then went through GE. During our lifetime, we've seen 3 or 4 insurance cycles, and people that start companies at the right part of an insurance cycle tend to make a lot of money. A very key part of our life was the tragic events around World Trade Center, 9/11, and Trevor became one of the founding underwriters at Arch Re, which has been the most fantastic stock to own over its 22-year life. I was at Brit at the time. We founded Brit in 95. After World Trade Center, we raised a fair amount of money, and Brit went on to become a £1.3 billion. It's, I think, the second largest insurer in Lloyd's today. The cycles were very strong in the early to mid 2000s, peaking in about 2012. Lots of people made a lot of money. The market then softened. And the cycle will never die. We're not cycle deniers in any way. Market softened, and we were aware that lots of people were losing money around 2016, 17 and 18. And we fortuitously met and thought we would put together a new vehicle, go off and raise $1 billion of capital. And so we proceeded to set around the fundraise, which we finished up IPOing during COVID, which was a fascinating experience for all sorts of reasons. But we closed the deal on the 1st of December 2020 in time for the 1/1/21 renewal season. We set out in the IPO document to get to $1 billion of income by year 5. We have surpassed that figure in year 3. In 2023, we made just under a 20-point ROE. It does take time to ramp up a new business. There's so many things that have to happen, and you'll never work so hard as in the early years when you're establishing yourself. But we made a 20-point ROE just short of last year. On an annualized basis, we made just shy of a 20-point return in the first half. We do write a substantial non-cat and quota share book, which means we will be impacted by small to medium-sized events. It means that we have a lot less exposure to tail risk, or what people would call super cat. But I'll hand over to the team now to go through the update, and obviously we'll be happy to take any more general questions on the company at the end. But Trevor, over to you.
Thanks, Neil. Thanks very much. Next slide. Okay, so we've got a series of slides here which summarise the Q3 trading update that we just announced to the market. I'll move through these and pick out the pertinent points, and Lane, our CFO, will also comment on some of the financial aspects. So through the quarter and certainly through year to date, we still saw continued growth, measured growth as we refer to it. Gross premiums written of 957.3 million through the year to date, end of September, which, as the slide says, took us through the 23 premium totals at that stage. We've seen good growth this year across the classes, property, casualty and specialty all growing, but as you can see from the slide, we called this out before, the 25.2% growth driven by property and specialty, where specifically we have identified some time ago, and it's still the case, that that's where very good opportunities lie and certainly where we skewed our capacity allocation when we're looking at business that flows into Conduit. Through the quarter, as we've said here, it's an active period for the smaller and mid-size Nat Cat and large risk events. And what that means was through Q3, around the globe, there were a number of sizable and notable Nat Cat events and also some man-made events. We participate in those, we share in those losses by virtue of writing quota share business, and we've reported that our involvement in those large risk events and the mid-sized Nat Cats was approximately $50 million. Come on to that a bit later. Following loss events of the third quarter, undiscounted combined ratio was in the mid-90s. That's on a year-to-date basis and through 30th September. And then the last point around sort of the loss activity in the year-to-date, and this occurring in October, Hurricane Milton, which was the pretty well reported hurricane event in Florida that went through. At the time of Milton approaching landfall, it was feared to be of a much larger scale and size. As it turned out, it was obviously a catastrophic event for that part of Florida, but not at the level that it was originally feared. Nonetheless, loss events are being reported across the industry now, and estimates being put out there. And for us, we put out a loss in the range of $30 to $50 million. It's a loss estimate at this stage, which we'll keep under review. We set a range around it, around the event. There's a lot of loss information still being provided by clients and by the original homeowners, and in a number of cases, business owners. And the loss range for us is in that $30 to $50 million range, which as a range compares reasonably favourably with what you probably will see from other companies in the market. And certainly the range around this event is still quite large. It will become more certain as more information flows through. Rate change, we're still seeing good rate change in the portfolio. We report ours net of inflation. Year to date across the entire portfolio was 1%. And as I say, that's after providing for inflation allowances. So that's the net impact as a positive sense for us after allowing for inflation. I'll come on to this in a moment. We've got slides around property, casualty and specialty, but you can see there the difference in rate change across the three different classes. Final point, since we started in 2021, we've seen an enormous amount of business, got a very strong capital base and very strong client relationships going back to, which I suppose is a reflection of the length of time that we've been in the industry. But the partners that we have on our books, we share across a number of lines, property, casualty, and specialty, and very often those partner clients that we have, we trade and transact with them across all three divisions. Next slide, I think. Slide showing the gross premiums written since Q3 2021. So the year-to-date numbers, and it shows the progression. It shows quite clearly where we've been growing over the 4 years of our iteration. The 285 million Q3 21 through to the 957 now. And also you can see where the growth is coming from. The dark patches, $536 million of property and specialty at the top of 197 million. It's big growth in those in the year to date, year over year. And as we've called out a number of times, that's very much where we see opportunities and generally the larger, more attractive margins for us across the reinsurance landscape. I'll come on to it in a moment as regards the individual classes, but it's the property and the specialty where we've seen specific opportunities. Rate change on the right hand side, again, that's a blended across property, casualty and specialty. The 1% risk adjusted rate change is driven, as I say, after claims inflation has been provided for. And within that, we're showing the rate change, obviously, from an index of 100%, the starting point in 2021. The reality has been there's been compounding increases over a period of years, and really the market as a whole, if you think about it, really from 2020 started to show material uplift in rates, but generally across the reinsurance landscape. So in the time that we've been a transacting business, particularly our 4 years, we've been benefiting from previous compounding increases, and as we've shown to this in this current quarter and this year to date, we're still showing a positive upwards trend. And that's a good place to be deploying capital into. Next slide, please. Property. So similar slides, similar makeup, but around property. Again, you can see that 33% growth in premium over the year to date, year over year. The points that we're making down the bottom, that quota share focused portfolio, including non-cat and cat, and that's important to convey that across the entire portfolio, property, casualty and specialty, approximately 2/3 of the premiums that we transact are non-cat related. So lines of business across property, casualty and specialty tend to be much lower correlated with cat events, and indeed they're often what produce what we refer to as risk return as opposed to cat related return. And it's an important point in building a diversified portfolio. In the property book, we do have strong elements of property risk which are not cat exposed, and that's a theme that you'll see running through property, casualty and specialty across these three slides. 3% risk adjusted rate change, that's very much a rate change applied across the entire property portfolio. It's important to point out that we write a geographically spread book of business, and that rate change will be a blended output from various geographies around the world. Given the impact in the US over the course of the last couple of months with Hurricane Helene and then Hurricane Milton in October, we are expecting to see a significant rate change in the way that business is presented to reinsurers over the course of the coming year. The losses that are deriving from areas of Europe, which you would have seen in the press, will also be producing commensurate rate changes on the back of those losses. Other areas where loss events have been more benign will obviously be showing much reduced risk-adjusted rate change. So it's important to point out that 3% is a blended figure across the geography and the various lines of property business that we write. Next slide. Casualty, so our third-party business. Premium increase much lower in this class, as we have been calling out really for some time that the casualty business for us is a great book of business that we've built up. We've got a great core partnership list of clients that we work with, but casualty business, we're still seeing parts of the market where inflation is still moving ahead quite strongly. In a number of cases, in assessing the treaties that we're presented with, we don't feel that we're in all cases being rewarded for that or paid for that. So it causes us to have quite a high decline rate in casualty. So we're still adding to our portfolio, but much more limited growth. And we're comfortable with that. Our approach on casualty is to deploy capital cautiously and in a measured way. And in casualty, for us across the different geographies, it's a class of business that certainly we spend a lot of time researching, building up trends and patterns around aspects such as social inflation and underlying claims inflation. Overall, after allowing for inflation, we're showing a slight negative downwards tick in rate, down 1% year to date. Overall, we view our book as still very rate adequate. So we like the margins that we are achieving on the casualty book in terms of where we're dialing the pricing on it. But it obviously takes time to develop through, and in terms of ultimate claims to be settled and developed into the portfolio. But overall, really good book of business. We're there in the market. We look for opportunities and deploy when we can. Next slide. And then this is the final one around the individual classes. So specialty. Specialty covers a very broad range of classes in the industry generally. We transact a number of those. It's probably worth highlighting those that we are either minimally involved in or avoid completely. We don't get involved in crop business, primarily because it is highly correlated with natural perils and cat events. Mortgage business, any form of life specialty we don't get involved in. And we're very light in classes such as political risks. So classes of specialty insurance that would respond to political or economic downturn is probably the best way to think about it. Trade credit and the like, we don't transact those classes. Main reason for those is that they are, again, or can be, reasonably highly correlated with the asset side of the balance sheet. So we avoid those. But especially for us, covering classes such as marine energy, liability in those classes, political violence and terrorism, so events associated around terrorist acts around the world. Those are the sorts of classes that sit within our specialty portfolio. Overall, we've seen good growth, 39%, up to $197 million year to date. And we're still seeing areas of specialty that, in spite of, I suppose, several years of the specialty market pre-21 somewhat languishing in the doldrums rate-wise, since then we've certainly seen a good uptick across it, and overall across the classes that we deploy in, it's showing still good rate adequacy across the piece. Net of inflation, we're showing say the plus 1% in the quarter, and again, inflation can be a significant part of the specialty book, and it's a factor which we track individually per class and very much actually across different geographies. So those are the three classes. Next slide, please. So pass it to Elaine for some comments around financial highlights.
Thanks, Trevor. A lot of the numbers on this slide Trevor's already spoken about, but just going to wrap them up after the run through of the specific divisions. So gross premiums written for the year to date of $957.3 million, which is up 25.2% on the prior year. If you were following us at the half year, you would have noticed higher growth at the half year. We did have a conversation at the half year about the fact that we had front loaded our business for the year, and we expected that growth rate at the half year to soften a little bit into later on in the year, and that's happened. So front loading and 25% growth for the year to date, which is still very strong growth. And that translates into reinsurance revenue of $588.2 million, which is up 30.3% on the prior year. For those that aren't quite so familiar with IFRS 17, reinsurance revenue really represents, under older accounting standards, what gross premiums earned would have been less ceding commissions, and then a smaller adjustment for non-distinct investment components. But it really follows the pattern that our gross premiums earned would have, just at a lower level given ceding commission deduction. Another note there on the loss activity for the quarter. As Trevor's mentioned, no major events in the quarter, but there was a frequency of events in the small and kind of mid-sized space. None of those were individually significant to us, but we did feel it was appropriate to disclose the accumulation of those events in the quarter. So $50 million across events in Canada, hurricanes in North America, and a few other kind of risk events in there as well. So we don't typically disclose full numbers at this point in the year, but we did feel important to disclose that number and give some context around the frequency of the events in the quarter. Next slide, please. On investments, reduction in yields in the quarter, so that gave us a good mark-to-market gain on there, plus generally a higher yielding portfolio given the way that rates have moved over the last number of years. So we generated a return of 3.4% for the quarter, which brings us to 4.9% for the year to date. Book yield you'll see there is now 4.2% versus 3.5% at the same time in the prior year. We are still fairly short duration in our portfolio and maintaining our focus on high quality and high liquidity. Duration is at 2.5 years just now, which is slightly higher than we have been as we went through the rate hiking cycle, and that's versus 3 years on our reserves. So we are kind of keeping those two numbers under review in terms of making sure that our duration on our asset and our liability side are within a reasonable balance. And as the rate hiking cycle does reverse, we will end up increasing our duration on our assets just very slightly. Average credit quality there is AA, and there is a pie chart there with the asset allocation, so you can see the asset categories there, and no real changes in those over the quarters. And I'll hand that back now onto the next slide, please, for Trevor to wrap up.
Right.
Oh, we can't still on.
I think so. That concludes.
There was one summary slide.
Yeah, that concludes the presentation that we have for today. If we can move into Q&A.
Yes, of course. Thank you very much for your presentation. What I'll do is I'll just bring your camera back up in the room for the Q&A. Ladies and gentlemen, please do continue to submit your questions, and you can do that just by using the Q&A tab, which is situated on the top right-hand corner of your screen. We have received a number of questions already throughout the session, and I'll start with the first question here, which reads as follows. How is your diversification strategy evolving to buffer against potential catastrophe events, especially with increasing frequency of natural disasters?
Okay, that's a simple outline question. The diversification strategy that we've employed from day one still holds true today. So in looking at the individual classes of business and the portfolio, we think of it as the provision that we make for attritional losses, which are the day-to-day losses, and then the large events, the one-off, typically man-made type events, and then the natural perils ones. Across the overall portfolio that we've got and that's been built up and developed through into the current year, the diversification has continued to act very much in our favour. The quota share book in particular has large elements of non-cat related premium in it, and across those geographies particularly, that's still adding significant diversification to the portfolio's impact, being impacted from large risk events and or natural perils ones. As the portfolio grows, typically that tends to strengthen as a diversification balancing item. That's, I suppose, largely driven by the law of large numbers to some extent, but the portfolio has currently very good diversification within it. The increased frequency that we've seen in the current quarter, where we've pointed out the $50 million around smaller nat cat and large man-made risk losses, is a situation of increased frequency around those particular types of events. It's not an additional concentration, it's really an increased frequency in the quarter. But overall, if you look at it in a larger time frame, over a larger time frame, typically over the course of a year, the pattern of diversification that we are achieving is still very good within the portfolio.
Perfect. Thank you very much. The next question here, are there plans to expand into new reinsurance lines or geographic markets?
We're always alive to it. We receive a number of, if you like, offers from clients, typically clients that are already on the books, the multinational clients, where they're expanding into new territories. We are certainly cautious about underwriting contracts and increasing our profile in territories where the rule of law, shall we say, and contract law particularly, is on a different level to what you see typically in the US, Europe, or the UK. So we receive a lot of offerings from territories which on the face of it would certainly introduce diversification to the portfolio, but the point is for us at what cost and at what terms. In terms of a general comment where we are now, Europe, given the incidence of loss that's occurred there over the course of the last, certainly the last year, in the property world, so higher incidence of floods and storms in Europe. We are currently, shall we say, under-deployed in Europe. That's deliberate because of the level of pricing that we've seen there. It's not been that attractive to deploy into Europe. I think you could see, for us, receiving an increased number of submissions from parts of Europe that are going to be showing rate increases going forward into 25 that could well now move into our pricing hurdle, our pricing window. So that could be an area where I would expect to see us perhaps deploy slightly more than we have done in the current year.
Perfect. Thank you very much. The next question here: how sustainable are the growth rates, in particularly in the property and specialty segments?
That's a good question. If you look where we've come from, there were some very large numbers. The nature of the starting up a business. Obviously, everything's new that you write in your first year. You then add new to your existing renewals. And where we are now is there's a compounding impact of renewals that we're seeing on the books, renew through, and then we add new to it. What we are seeing is that growth rate that you see in, well, the two growth rates around property and specialty, it's not just about writing pure new, it's renewals that we have on the books, come for renewal, and typically in contracts that we write, we have a percentage share. As examples, property contracts, we may have a 5% share on a contract with a client. We really like what that client's doing. It comes up for renewal. We can move that to a 6 or 7 or 8%. You can increase that. So there's still some headroom to lift those shares up with clients, certainly. The rate, pure rate, as a simple mathematical exercise, is trending down as we rely more on renewal business and not pure new. But I think we still are expecting to focus on property and specialty as the main areas for us. And I think, we've still got reasonably good designs on growing that portfolio going forward. Although, quite correctly, the absolute number may well trend down.
Thank you very much, Trevor. Next question we've got here: following the interim dividend, what is your approach to shareholder returns amidst growth and capital reinvestment needs?
Yeah, we have a standard dividend policy that we've been following since we started. So matching interim and final dividend, and there's nothing at this point that makes us want to change that policy. We are very much still at the point of deploying the capital that we raised at IPO. So in the near term, it's more about putting that money to work and maintaining the dividend policy that we've had.
That's great. Thank you very much, Elaine. And the last question we've got so far is: you mentioned a resilient pricing environment. What factors contribute to this outlook?
As a general comment across the classes, it's twofold. One is the demand from clients. Obviously, supply and demand, we all understand that. There is still enormous demand from clients for limits, for protection. Property as an example. There was a sort of an industry quoted or reported number that in 2022, across all of the US, the insurance companies, who are our clients here, basically bought $22 billion more limit. The current number for the 24 is rumored to be in the 9 to 10 range. Those are industry figures which are kind of generally reported. So that demand has to find a home somewhere, and that is still underpinning pricing in the property space, particularly. On casualty, especially, it's more inflation driven. We're still seeing signs of what you would refer to as social inflation. The tendency for juries, for example, to award in the States more of nuclear type verdicts, and the general approach to more litigious society. That's underpinning casualty pricing. So from two different aspects: demanded on property, more inherently led by underlying inflation trends in casualty. That's what's driving the demand for the product that we sell, and really adds resilience to the pricing.
Thank you. That's great. And thank you for answering those questions from investors. Of course, the company can review all the questions submitted today. We will publish those responses out on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Neil, could I just ask you for a few closing comments?
Yeah. So thank you for your time. And I mean, my closing comments is that we are in the middle of an extremely hard reinsurance market. This is demonstrated by the year-to-date growth of 25%. Markets are in generally a resilient and profitable position. This quarter, we have seen claims volatility, but in spite of that claim volatility for this particular quarter, I would still expect to see a satisfactory result at year end. And we're looking forward to the 25 renewal season, which is almost upon us, and we expect continued growth there. So thank you.
Neil, Trevor, Elaine, thank you very much for the update today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team at Conduit Holdings Limited, we'd like to thank you for attending today's presentation, and good afternoon to you all.